Go, Benny of Arabia. It's topical, but let's talk about rates first, because whether it's changing odds around who's going to be the next Fed chair or whatever, but we've seen some significant moves at the front end of the SOFR curve, and you wanted to talk about that, Benny, to kick off things.
Yeah, I'm a little caught off by it. I've been sitting in the H7 SOFR H7s for a bit, and there was an expectation in the forward curve that Hassett was in there, and the economy is going to get weaker, or there'd be a risk off. So basically, it'd been pretty sticky. It got a little ahead of its skis up to like 97.10. And then came back to 97.90 and it sat around there for a while. And then I looked up one day, I was like, man, I just lost 14, 15 bips. And so you had kind of a little under 20 bips of cuts removed. So like almost a full cut, not quite, in the last little bit. And I think ultimately, because what does your chart say 2 weeks ago?
So you're in the H7s, right? Which is essentially this belly of the curve here. So
yes.
You can't see your cursor here, but the delta really effectively since the start of the year is that belly bit moving.
Basically
3.1 to 3.25, basically.
Yeah, your host Benny is took that one on the chin. And
don't worry, I've got a couple of those too.
Well, yeah, I don't know. It's strange because I saw the Philly Empire, Philly Fed or the Empire, whatever, one of the manufacturing
survey.
Yeah, exactly. Came in and was okay, and like there's noise. I never get too bent out of shape on any single data point, but there's a lot of mixed signals that are going on. So it's until the market sees something that gives it a sense of imminent collapse or imminent rollover. I think the fall with the government shutdown and all that, you did see in the credit stuff and the auto stuff, but until they lose the K economy narrative and the AI spending narrative and the government deficit spending narrative, I think that the market's basically saying, hey, rates getting dunked on and going down to 2% or lower isn't in the cards right now. So I still think there's an asymmetry to it in the sense that I don't see us going into hiking, but you never know. Our buddy Dave Dredge, who we had last Thursday, he wrote a piece a while ago called Deja Vu, and he was talking about in the 90s where they tried to cut and then they had to reverse. Now they've cut a lot here, right? So we were at 525, so we're 160 bips below that roughly now. And so it's a little different than that 50 basis point cut that they did in 98 and then had to reverse and do another 150. Plus, I just don't think that there's really anything that I see. Inflation seems to be coming down, but prices are high. So, it's a rate of change versus level like situation. And I'll tell you what, to go back to what we talked about first, seeing what's coming down the pipeline in these agentic AI, a lot of these services guys are going to have a hard time keeping their prices where they are because they're going to be guys who come in and underprice them. And we've seen that in many industries before, right?
Yeah, I think that's interesting. I mean, the only thing, I'm wary of indexing or leaning towards any data at the moment. The official data, the hard data is so messed up with government shutdowns and with all of the various adjustments that are going on to the numbers, rightly or wrongly. And that's on the hard side. So, how much can you lean on it? And on the soft side, frankly, for the last 2 to 3 years, they read like political opinion polls, right? Sentiment surveys are totally determined by who you ask, right? And so I found them less valuable. I mean, so together with this move at the front end, most of the year so far, we've been in flattening mode. Not much, no need to spend too much time on this slide. This is another way of looking at. You can see at the front end of the curve, all of the solid diamonds, which is the current price, are well above the range, and this is the year-to-date trading range. The change is much less marked as you go further out the curve. But the question is, and that's the title of the pod today, is this flattener going to kill the regional banks rally that's been going on, for a healthy period of time? Remember when we wrote them off all as dead in March of 23 with Silicon Valley Bank? So just to explain this chart, and then I'll get our beautiful mugs back on full view. But you've got the 2s, 10s in blue shaded just against the KRE regional bank ETF here.
Yeah, I think that when you think about regional banks, they're much more pure play carry traders in the sense that they borrow short, lend long. So curve steepening increases their net interest income, margins, if you will, to use the operating side of the business.
Well, we're going to come to Japanese banks in a little bit, which I wrote about over the weekend. That's been the story of them over the last sort of 18 months or so. But back to the regionals. Charlie was very interesting Charlie Peabody was very interesting when he was on with us the other day. He definitely sees the financials weakening, and given the sort of softness in Mag 7, that could be enough to tip things over completely at the market level.
Yeah, so we had a weak start to the earnings season with the banks last week. We had, some of that was Trump talking about 10% interest rates on credit cards, but some of it was, there were not enough buybacks for JP. I mean, there was but in general, banks, as you saw in that chart, have had a really nice run as we had this real, kind of a mega steepener, if you will.
Yeah.
And it's an interesting steepener because it's a true bull steepener in the sense of drop in short rates and long rates came down some, but they didn't come down as much. And the reality of the situation is that, and look, I got paid a year ago in the first quarter being long the Z6s pretty good. And I think I get you in a little bit of that too, Mr. Squirrel. And then it just stopped. And, we've just been flat as a board in the forward curve for a while. And there's been range bound trading, which has been okay if you're, monitoring it on day to day.
I think both of our P&Ls would have been a lot better if we just given up trading sofas in Liberation Week, right?
Totally. Yeah. And just bought, gold, just bought silver. Silver. That's it. That was the 2 trades of the year. And then been like, hey, this is how you run a portfolio. In the Q1 when you're bearish, you run the long SOFR. In the Q2 through 4, you long silver. You would have had quite the print.
So for all you comic book fans out there, 2025 was the year of the silver sofa. No, too much. Ben, I'm assuming you didn't find that remotely funny, or your internet connection's off.
I did. Sorry, I should have given you a better laugh.
Sorry, I crack myself up at times. So, listen, we've seen quite a lot of assets that we've seen quite a lot of assets that have rallied hard from November through to now. And the banks, yes, they started earlier, but it's really kind of accelerated recently. It feels to me like everyone's getting a bit long, right? This is the Goldman prime brokerage survey here, and you're at juicy percentile levels. Does that jive with what you're hearing anecdotally?
Kind of that's what it feels like when you look around. We talked about, you saw implied correlation, 1 month implied correlation get down to sub 7. I mean, that's bare bones. And you see it in asset prices, on a diluted PE trailing, the S&P's at 28 times, right?
I'll show you that in a second. So this is just managed money holdings in equity futures. We're at post COVID highs, well, almost within spitting point, and it comes, just as we're at 2 standard deviations in sort of next 12 months forward earnings multiples for the S&P, right? That's a pretty punchy price point to be max long, right?
I mean, it's not exactly where I'm a buyer at. It's very difficult. What is that? 23. So you're four and change. Yield 10 years at 4.25 and change. It's up a little bit. So you're talking about no excess premium over the 10-year. I mean, historically, that's not, if you think about initial conditions, that's not conducive if you look at the forward returns from points when it's there. Now, the argument always is that it can get more negative, right? So yeah, you can get more of a bid. And so, the direction is more important, or the rate of change is more important than the level. But yeah, if you were just to say blindfolded, do you want to be buying at 23 times with the bottom half or bottom 2/3 of the economy, in not great shape, and the AI spending kind of seen a lot of pushback in the US? There's just growing numbers of data centers that are getting rejected, and I think it'll be a political event, or big political issue. My sister has been covering this for her radio show and for her article with the local Milwaukee newspaper, and she's just saying that it's picking up. So I think that people are aware of their power bills going up, and we're going to have my buddy Tom Jens, who's a physical power trader, come on here as our guest this week. So we'll get more into power later this week. But people notice the utility bills going up, and they hear the stories about the brownouts and the water issues. So I think also, I was again sitting face forward with like the front line of this stuff yesterday. I mean, people are worried. If you're a mid-level services oriented guy, I would be worried. I sent you that thing about Chegg. There's just some of these SaaS guys. They're just gonna start losing people. You're gonna start seeing it more and more, I think.
Well, we'll come because I wrote about that yesterday, actually. So we're going to get to that a little bit later. Let's just stay on the market for 2 seconds. I mean, this is just the E-minis, the S&P E-minis, and I've just put on. It's a little bit of busy chart, but this is the Bollinger Band Keltner squeeze. So that we've just gone into a squeeze on the daily on the ES contract, and as you can see in the lower panel there, you've got fading momentum. I mean, we haven't seen a new high in the triple Qs in the NASDAQ for what, 3-4 months now. It just feels like steam is gently sort of coming out of this market. Listen, I don't have massive equity shorts on right now, but it feels to me that the risk is to the downside rather than the upside here, particularly after that last week in banks.
Yeah, and I had sent you a different chart that kind of showed this trend break. I mean, look, we haven't mentioned it, but it was a decent red Sunday open, right, last night. And I'm looking at the 24-hour market. I think NASDAQ futures are off about 115 bips.
Yeah.
S&P is down about the same. The general theme right now is risk off. I think some of it was from Trump's Greenland comments, and then the EU talking about retaliatory tariffs and all that stuff. And without getting into that, just think that maybe it's more about what we're talking about, which is positioning is a bit long in the tooth, and it's going to be harder to find buyers. And there's a lot of geopolitical things going on. The Iran thing, the Venezuela thing, the constant great power game with China. I mean, no one's even talking about Ukraine and Russia these days. That's like, but I don't think that's gone anywhere. I think that's still.
No.
I think bullets are still flying there, right?
Absolutely.
And we got a midterm coming up, and a new Fed governor. I mean, there's just a lot, right? When you just look out.
Yeah. The new Fed governor is going to get tested by the rates boys. They always do. My issue, and we're getting tape bombs geopolitically left, right, and center. One thing I sort of stuck in the note last night was this is the emerging market index, the EM, versus the S&P 500 versus the SPY. Now, this chart has been below its 200-week moving average apart from a couple of peaks, and you can see the last one there in mid-2018. it's been under the purple line, which is the 200 weeks, since 2012. To be honest, closed at it on Friday. If we think the big boy in terms of the SPOOs is rolling over, can this relative recovery sort of carry on? I mean, you know my bias, and I know yours, but it'd be interesting to see if a risk-off event in US financial assets could happen independently from the rest of the world. If we're talking about sort of major,
No, I still don't
players,
think
right?
so. No, I don't think so. I mean, it's still just so connected. So much of it's dollar based. It's algorithmic. So these guys, Jane Street trades in every market, don't they? So
Yep.
the liquidity
Except
comes out of there.
they've just had their computers kicked out of the Shanghai servers for all the high frequency guys. Did you see that?
No, I didn't. But hey, look, that's it's
Trading
interesting.
almost everywhere, I think you should say now.
Yeah. Well, I guess my whole point is that you think about that. That's actually an interesting little data point in this like regionalization, deglobalization, whatever you want to call it, of the world. Of like, if you think about this Greenland thing, I know everybody's up in arms, and the average American doesn't think about statecraft, right? They just enjoy the benefits of American statecraft. They just are like the most, and look, as an American, I feel okay saying this, they're just the most privileged people in the world. Like, deficits don't matter, 2 oceans, most oil, most gas, most fresh water. And, there's things that are done sometimes to try and maintain their
Well,
situation.
I'm going to bump this slide up, right? Because, it's definitely become a topic in the last 48 hours. You know, I do believe, and actually everyone's going on about foreigners dumping treasuries. I don't actually think that that's the most likely move. I think that, you know, the big, the big Achilles heel is foreign holdings of US stocks, right? And it feeds into what we're going to talk about with Mike Green in terms of, so these inelastic markets and his whole passive theory. But my contention is that if other countries did what South Korea did a few weeks ago and started incentivizing domestic owners of US stocks to bring their capital home in this case with a tax break, for me, messing with the treasury market is mutually assured destruction, but encouraging a bit of repatriation of equity funds. Now, in an election year with the US economy so financialized, this is the interesting thing to think about in my mind. I mean, just a simple,
Well, everybody's financialized though, Rupert. I mean, I hear you,
no,
but
no, no, no,
your
no.
home country's the historically most financialized of everybody, right? I mean,
No,
you guys even
I
produce
agree.
widgets.
I agree with that. I'm talking about the way.
Canada's wildly financialized, right?
No,
With their
no,
real
no,
estate.
not in the same way as the US. If you wanted to think about what happens to consumer spending in the US once people's 401ks start going down, that is a nightmare scenario for the Republicans going into the midterms. I really do. I think this is a far more potent weapon that foreign governments have when you've got the toddler having tantrums and wanting countries. But a lot of smart people. Shout out for Kev. He wrote about this very well about a week ago. Hunt that down. My buddy Chase Taylor at Pineco Macro was talking about this whole capital wars and capital controls topic in the middle of last year. And Matt Casey, who I'm going to try and persuade to come on the Benny and the Squirrel at some stage. He's a very good political consultant. But I think watch this space. I think it's interesting.
Don't disagree with that. Let's go
Absolutely.
back to where we were on the slides.
We were just about to go and talk about. I was about to pivot completely to Japanese banks, So unless you want to stay sort of high level, I will go there.
Yeah, that's fine. So I mean, I would just add that, like, I was just talking with a buddy. I think that there's a decent amount of complacency here. So with all these things going on, Q1, and we're getting into the, the operating non-financial part of earnings. We have that going on. See what they say. And again, new Fed governor in May, tax day in April, normal liquidity suck in March. Positioning's more levered than it was, and it's very eerily similar to the Q1. And again, it's a midterm year, which for the last however many midterms have been bad years. So, the red today doesn't mean anything, but it's worth keeping an eye on here, because I do think that when you talk to people, it's been so unabated, and then even that fall, the rally off that fall was so strong that there's just kind of it's a decent amount of complacency. And by the way, top of the market's been trading fairly poorly.
Yeah, the mags are horrible. Actually, that's quite interesting. I mean, we'll maybe come back. But let's do this one first. So I have a watch list of all country ETFs, right? And country and sector ETFs. And I just look at software and WisdomTree Cloud, which is WCLD, which is like a one-stop shop for SaaS businesses. The year-to-date performance. First observation. Firstly, the cheaper you are, the better you perform this year, right? There is a sort of shorter duration rotation going on there. The mags are bottom right here as well in terms of expensive and underperforming. This was going to be the lead into the discussion about SaaS, but I thought you brought up the top of the market. It's really looking unloved so far this year.
Yeah, to my delight, I guess.
But back to these Japanese banks. I went through the process. So Japanese banks, particularly the big ones, but actually I own 1615, which is the Topix bank ETF in Japan. But you've all of the big ones, which are 70-80% of that index are traded in an ADR form in the US. I first got into this trade in late 22. I've been washed out a couple of times, got back in a couple of times, but it was always a value plus normalization of the Japanese monetary market trade. I was first nibbling at these banks at 0.6 times trailing book. They're now trading at 1.5, right? So I had to justify what is now a narrative pivot, which I'm pretty comfortable. I'm pretty comfortable with what they can do in the coming years as they have excess capital to grow their balance sheet. They don't have any experience. They don't have. You were talking about the Japanese long end earlier. They don't have any duration. There's no Silicon Valley bank sitting in Japan. These guys have an almost free funding base in the form of you've got even with policy rates at 75 bips, you can't get more than 30 basis points on even as a corporate depositor in Japan, and yet they're happily lending at the prime lending rate. So they're getting this wonderful sort of Jaws effect for their net interest margins, and they're going to be accumulating excess capital pretty quickly. Spend a bit of that on their own stock, but they're going to have to start growing their assets in the coming years. And I think that this sort of narrative pivot from value to growth in the same stocks is going to end up being justified.
Growth banks? Are you pitching me growth banks right now?
No, I'm not talking.
I'm going to say that's an oxymoron, my friend.
I think these banks are going to be growing their earnings meaningfully, and I think that the thing about sell-side analysts in Tokyo is that you've munched through 2 generations of sell-side analysts there that have got to factor inflation and growth into their models, and so they've been constantly behind this re-rating over the last 18 months. I think they're gonna start paying catch up, and the banks report Q3 in early February, and then the full year out to March 31 in May. I think you're going to see these banks get re-rated up.
Well, look, let me show you something real quick. I'm going to add this to the stage. This is Mitsubishi. So
Yeah,
in January 21, I bought Mitsubishi for around $4 or something like that, or maybe a little less than $4, and it was like just, I don't know, 0.4 times book or something like that. And so this is clearly, the Japan has been the best steepener in the world. And
yeah,
kind of to go back to our conversation earlier about the regional
yeah. It's all
banks in the
linked.
US.
Yeah,
Yeah, exactly. And so I'm just saying, like, it, as a guy who bought it down in the you know, when it was down there near the lows, very hard for me to get excited about now Mitsubishi gapping up, 60% of the value that I bought it for in, whatever, 2 weeks.
absolutely. And this was the process of my note, which thank you for admitting effectively that you didn't read it.
What did you buy?
Uh,
I'm buying 20 hours. Give me a
I know
break.
you were. I know you were. You heard of airborne Wi-Fi? No. I was having to justify to myself sticking with the trade, right? And my conclusion was there are going to be probably macro and political, especially in Japan, bumps in the road over the next few months, which will create, I think, a viable dip in these Japanese banks. No, you can't buy them right up here, but you need to have some powder ready to buy any dip, because they've got the most extraordinary elastic bounce back properties. We saw it after SVB. We saw it after the August 24 carry crash. This asset class just ripped straight back into trend, right? I mean, you're almost behind within 2 to 3 weeks.
Yeah, I mean, look, the things that have worked have kept working, and it's a difficult thing as a trader. So if you're an investor and you kind of just sit in something and you're like, "Hey, I'm going to ride it." I know you're a trailing stop loss guy, but I will say that I noted, I actually did read the first part of your note, and I didn't get to finish it, and how you got swung out of those trades a few times
Yes.
with your trailing. I don't really believe in stop losses. I get it, but like the idea, I mean, stop loss doesn't help you in a gap down, does it? And I guess you can sell after the gap, but like it's not like a continuous market. And I personally struggle with when things go vertical, of like, hey, I want to keep riding this, um, just because I'm a mean reverting trader by nature. Um, but again, the way you make the big money is you just ride it and you eat a little vol. So I guess you'd have to convince me on these things. You'd have to convince me of the fundamental state. Like, here, this is what the curve is going to look like. This is what loan growth is going to look like. This is what the valuation is going to look like. And I'm not sure I'm ready to go with Japan banks. Would you say they were 1.4 times
Well, the big
book?
ones are 1.5. Yeah.
One and a
This
half?
is
Okay,
still trade.
1.4,
This is still trade. This is trailing book, right? So
yeah, but that's realized. Like, I
yeah.
with multiples, I get why people use forward multiples, but I like observable divided by observable. So that's the actual, right? So
Yeah,
you've
no.
had a huge re-rating, and what do you think they're going to go? They're not going to J.P. Morgan's multiple.
Well, they're not going to go to that. There are more expensive banks around the world. Australia is home of priced commercial banks. They're almost completely ridiculous here. But I think you know, I'm talking about a book value expansion story, not a multiple value expansion story. I think we're going to grow the book. Listen, a sector that we alluded to at the beginning that is not having a good start to the year is anything touching on software right now. I wrote a short piece on this yesterday, which you can find. That included basically piecing through that WCLD ETF. These stocks are insanely expensive even after the correction. on average, the software stocks in this ETF are trading on 7.8 times forward EV to sales, something like some close to 35 times EV/EBITDA forward, and 45 or plus times forward earnings. There is over 2 trillion of aggregate market cap in this space. Asking the question, could it be 30, 40, 50% lower in 12 to 18 months? Maybe a bit longer, 24 months? I mean, I do think that that SaaS could be, a gift of a funding short over the next few years. Now, clearly, there are a few names in there, that have got special situations. I think cybersecurity is something, particularly when your agents are prowling the web. Cybersecurity is something somewhere where the spend is going to continue. Obviously, by market cap, well, I just gave the aggregate market cap. Palantir is a very big number in that list. I mean, frankly, I find that a bit of a meme stock, and I never fight meme stocks. But it's definitely one to dig into.
Well,
The other thing,
what I'd go ahead.
yeah, no, go on. I was going to shift gear slightly.
No, I want to stay on this for a second. I was going to say, we were talking about this yesterday, and the reality is SaaS is just over earning in reality. Now that the time to develop and the price to develop software is essentially collapsing, a big deflation, right? Look, deflation's bad for stocks, first principles, right? Like, just, when you have a residual claim on an asset, deflation is very bad for you. Which is why, the stock market goes up, because the Fed and the government don't like to, have stocks go down. And so when we think about these guys, they have huge upfront costs, and they have pretty large per head costs. And then they have these consultants who come in who, to teach you how to use it. And it's just, it's too much. It's too much, because now guys are going to these guys and saying, hey, we can rebuild you their platform for this cost and customize it, and it's yours, and you own the data, and you're not a slave to these guys, right?
Yeah.
And so, or you let us use the data and you can pay a lower price. How that trade goes. Either you own the data and pay more, or you don't own the data and you pay less, and you're the product in some sense.
You're the product.
And so I just think that that's what's going on. The stocks are reflecting it. They're still good businesses, because I don't think SaaS is going to go away or anything. But the question becomes, what's the steady state multiple? What are these cost structures going to look like? And I think that you really got to know these businesses. And I've always had a hard time with SaaS stocks, because I just don't have the inside view to the firms of, like, how much people are they paying? How much are they paying people? How efficient are people? What does the contract portfolio look like? What's the, so I struggle to.
All I know is that everybody resents their Salesforce bill, right?
I think everybody resents. I think everybody resents all their software bills. I think that's the point.
Yeah.
I think software had an incredible run, starting with Microsoft in the 80s up until, 4 years ago.
Well,
basically.
And then they had the cloud revolution, and now they're all trying to pivot into the agent revolution. But that's not how the agent business works, right?
No, and I think you got to separate cloud. Cloud's just the real estate, basically, more than it is like software per se. And I'm talking about that
No, but this was the pivot. This was the pivot by the software companies into cloud and providing services within the cloud, and that enhanced their stickiness. And what really
that's when they really got. That's when they really.
That's when they went vertical on the multiple. And I think all of that needs to be unwound now. And I tell you what, the private equity world has really been filling their boots with software businesses in the early part of this decade, and then the credit arms of these private equity companies have been lending into these LBOs, and really massively overestimating, in my view, just how sustainable some of these recurring subscription revenues are. Now, this is this is what was a private BDC from Blue Owl that became a public BDC when, funnily enough, they weren't able to redeem in cash. Last June, they told their LPs that this was worth $20 a share. It opened at 16. They're claiming a 17 and a quarter NAV right now, and it's trading at 14 and change. But nearly 40% of the assets in this BDC are loans against software and IT businesses. I think it's just a really good ticker. OTF is the ticker. It's a really interesting ticker to keep an eye on. I don't think you want to, I don't think you want to be shorting BDCs, but keep an eye on it for the health of the software loans. And then just a sort of final observation, this is big PE. Obviously, it's had an amazing run off the run since November. Late October, early November. I think if SaaS starts to really melt down, I think that this could get these big PE shops back into a downtrend, particularly if the financials are having a tough time as well. And that, to me, looks like a lower high going in all of those big names, right?
Yeah.
Anyway, so that's kind of all we had prepared. So this is going to hit inboxes and be up on YouTube ahead of the open today, and there'll be show notes for all of you that follow us at blindsquirrelmacro.com. And Benny, what's your Substack email address?
Capital misallocation.
Capital misallocation. Make sure you follow us there, and slides and show notes available with the YouTube link. All right, everybody. All right. Thanks for everything. Benny, you have a great rest of the day, and we will catch up with Tom whenever I can't.
Yeah, this week. We'll try to have it out Thursday. Maybe it comes out Friday. But yeah, no live shows this week because I'm traveling to Dubai, and the time schedule, the time zones is a disaster between Melbourne and Dubai, and trying to broadcast as Eastern time in the US is not exactly the easiest thing. But we have my buddy who's a physical power trader for 20 years, and we're going to talk about some of the misperceptions in the market. Do we actually need more transmission lines? What, the equity tourists are seeing that he's not seeing, and a few other things that are a little more nuanced and detailed that you'll get from an actual power trader who settles on physics, not narrative.
Fantastic. That's going to be fascinating. Listen, thanks everybody for sticking to the end. Benny and the Squirrel out.
All right, guys.